Imagine you did everything right. You read the books, you listened to the podcasts, you skipped the vacations, cut the subscriptions, and for 3 years you watched your savings account slowly climb until it hit the number everyone told you to hit. 6 months of expenses, sitting right there, untouched. And then inflation ran at 8% for 2 years straight. And you didn't lose your job. You didn't have a medical emergency. Nothing happened, which means that money just sat there and quietly, invisibly, lost about 15% of its real purchasing power while the stock market doubled. You followed the rules perfectly, and the rules cost you. That's not a cautionary tale. That's the actual math. And it raises a question nobody in personal finance really wants to answer. Is the emergency fund, in its current form, one of the most financially damaging pieces of advice being handed to ordinary people? Let's back up. The emergency fund is sacred. It's the first rule, the foundation, the thing every financial influencer, every bank blog, every well-meaning relative has told you to build before you do anything else with your money. 3 to 6 months of living expenses, liquid, in a savings account, don't touch it. The logic makes sense on the surface. Life is unpredictable. Cars break down. People get laid off. Medical bills arrive without warning. Having a cash cushion means you don't have to go into debt when things go wrong. That's real. That's true. But here's what nobody tells you. The advice as it's commonly given was built for a different economy, a different interest rate environment, and a different kind of financial risk. And when you apply 1950s logic to a 2020s economy, the result isn't safety. The result is a slow, invisible tax on your future. To understand why, you have to understand what cash actually is. Cash is not neutral. It is not a safe place where money sits and waits. Cash is an asset class with its own return, and for most of modern history, that return has been negative in real terms, meaning after inflation, you're losing money every year, reliably. Between 2009 and 2022, the Federal Reserve kept interest rates near zero. A high-yield savings account in 2018 was paying somewhere between 0.1% and 2% annually. Inflation during that same period averaged around 2% to 2.5%. So, at best, your emergency fund was breaking even. At worst, it was shrinking, just slowly enough that you didn't notice. Then 2021 happened. Inflation hit 7%, then 8%, eventually topping out near 9.1% in June 2022, the highest in 40 years. The average savings account at that point was paying 0.06%, not 6%. 0.06. That is not a typo. Somebody with $25,000 in an emergency fund, a reasonable amount for a household in a mid-sized city, was losing somewhere between $1,700 and $2,200 in real purchasing power that year. Not because they spent it, not because the market crashed, just because it was sitting there, being responsible. Now, the obvious counterpoint, rates eventually went up. By late 2023, high-yield savings accounts were offering 4.5% to 5% APY. Suddenly, holding cash felt smart again. The financial press celebrated it. People called it a golden age for savers. And sure, for a window of time it was. But here's what that framing misses entirely. Interest rates at 5% don't exist in a vacuum. They exist because inflation got out of control. The Fed raised rates to kill demand and bring prices down, which they did. But by the time the rates peaked, the damage to purchasing power had already been done. The 9% inflation year came first. The 5% savings rate came after. You can't retroactively protect your money from the year it already lost. The 5% didn't cancel out the 8% loss. It softened what came next. Those are two different things. And then rates started coming back down. By 2025, we were back in a lower rate environment. The window closed. And most people, conditioned to think of their savings account as the safe choice, didn't move a single dollar. This is the part where someone usually says, okay, but the stock market could crash right when you need the money. And that's true. That risk is real. But let's actually examine it instead of just nodding at it. The standard argument is that you need liquid cash because if your car breaks down in a market downturn, you don't want to sell investments at a loss to cover it. Fair. But this argument assumes a very specific combination of events. You have an emergency and the market is down simultaneously, and you have no other options. That's three things that all have to be true at once. The odds of all three are lower than the conversation implies. More importantly, even if you accept the worst-case scenario, you need $5,000 right now and your portfolio is down 20%. You haven't lost $5,000. You've sold $6,250 worth of shares to get $5,000 in cash. That's painful. But compare it to the alternative. For 5 years before that moment, you kept $20,000 in a savings account earning less than inflation, which is a guaranteed erosion of wealth in exchange for insurance against a bad day that may never come. There's a name for that trade-off in finance. It's called the liquidity premium. You pay for the right to access money instantly. The question is how much you're paying and whether the price is reasonable. For most people with stable income, the price is not reasonable. It's just never been shown to them as a cost. Here's where it gets more uncomfortable. The emergency fund advice, at the scale it's given, benefits banks. Not in a conspiratorial way, just in a structural one. Banks take your deposits, pay you 0.5%, lend that money out at 7%, and pocket the spread. Your responsible savings decision is someone else's margin. The whole machine runs on the assumption that the average person keeps too much cash in low-yield accounts because they've been told it's the prudent thing to do. And to be clear, it's not that banks invented the advice. The advice predates modern banking products, but the advice has persisted long past the point where it was actually optimized for the people receiving it. The personal finance industrial complex, the blogs, the courses, the influencers, has a strong incentive to give simple, universal rules. 6 months of expenses is a clean number. It fits on a graphic. It doesn't require nuance or context. It feels responsible, and it doesn't demand that the advisor actually model your specific income stability, your risk tolerance, your asset allocation, or your real cost of holding cash. Simple advice scales. Accurate advice doesn't. So what's the alternative? And this is where it gets genuinely interesting because the answer isn't, don't have an emergency fund. That would be irresponsible. The answer is that the emergency fund, for a lot of people, shouldn't look the way they've been told it should look. Consider, what if instead of a 6-month cash buffer, you held 1 month of expenses in a true liquid account, 2 months in a high-yield or money market account, and the remaining 3 months in a taxable investment account in something conservative and diversified? You still have access to the full amount. You just have it structured so it's not losing to inflation while you wait for the emergency that may never come. Or consider that your emergency fund size should be directly proportional to your income volatility. A freelancer with variable income and no employer safety net needs a larger buffer than a tenured government employee with disability coverage and a union contract. The advice is the same for both of them. The math for both of them is completely different. Or consider that for some people, a Roth IRA, which allows you to withdraw contributions, not earnings, at any time without penalty, functions as a more efficient emergency reserve than a savings account. You can invest it while it sits there and pull the principal if you genuinely need it. Most people have never been told this. The 6-month rule doesn't mention it. None of this means the emergency fund is a scam. Let's be precise about that. For someone who is building from scratch, carrying consumer debt, living paycheck to paycheck, working a volatile job, or still learning to manage money, a simple liquid don't-touch-it cash cushion is the right starting point. The psychological value of that fund, the ability to sleep at night, the prevention of debt spiraling, that stuff is real and it matters. But the financial advice space has a problem with graduation. It teaches the starter lesson and then never updates the syllabus. People who have been earning a stable income for a decade, who have no high-interest debt, who have a growing investment portfolio, they're still following the rules designed for the person they were 10 years ago. The emergency fund, in that context, is no longer safety. It's inertia dressed up as prudence. The uncomfortable truth is that personal finance has always been sold as a set of universal rules. But money doesn't work universally. It works contextually. The same behavior, keeping $30,000 in a savings account, can be deeply wise for one person and quietly destructive for another, and the system, broadly, does not benefit from you knowing the difference. So, the next time someone tells you that your emergency fund is your financial foundation, ask yourself one question. When did you last calculate what keeping that money liquid is actually costing you? Not in the abstract, in real dollars, per year. Because somewhere in that number is the gap between the advice you were given and the advice that was built for you, and most people never bother to look.